Well, it's not long now until the Bank of England announces its latest interest rate decision live at midday. Let's take a look at the details. The current rate, which the bank set back in May, is 4.5%. Today, it was widely expected to increase to 4.75%. But amid inflation figures published yesterday, which remained high, some now expect interest rates could be set at 5%. Well, the Foreign Secretary James Cleverly told Sky News this morning this wouldn't mean a recession.
We need to grow the economy. High interest rates don't help with that. This idea that that we should consciously be going into a recession, I don't think is one that anyone in government would be comfortable subscribing to at all. What we want to do is we want to drive productivity. This is why the Prime Minister is taking both the immediate measures and also the long-term measures.
Meanwhile, James Murray, the Shadow Financial Secretary to the Treasury, says that targeted temporary measures are needed to help people who need it most.
What we think the right thing to do is to have a targeted temporary measure to help people through the immediate crisis they're facing in terms of their interest payments going up so much. And the way that we set out our 5-point plan means that, yes, people would pay more in the longer run, but that actually means that people will not take that decision lightly. To go to interest only or to extend their mortgage repayment period, which means that it will be targeted on those people who need help most.
Well, our business presenter Ian King joins us live now from the city. Ian, just reading the runes, is there any way of guessing what it might be?
Well, we're certainly going to get an interest rate rise, Jane. The only question is whether it's 1/4% or 1/2%. So really, it's a question of whether bank rate is going to go to 4.75% or 5%. Now, yesterday, the market was attaching a probability of around 45% to a half-point rise. That's slightly come off over the last 12 hours or so. The market's putting around a 1 in 3 chance now of a half-point rate rise. But it's very much in the balance, I think, following those inflation numbers yesterday. The figure of 8.7% for May, clearly very disappointing. The market was looking for 8.4. The number came in unchanged from April. It really does confirm that the UK just has this sort of issue with stickiness in inflation. It's not coming down as rapidly as anyone was expecting. And there are a number of reasons behind that. The chief one of which, I think, is the tightness in the labour market. You had a number of people that dropped out of the labour force post the pandemic, around 500,000 of them or so, and a lot of them have not returned to the workforce. Now, some of them just chose to retire and spend their time on the golf course instead, but there's a big chunk of the labour force that has not been able to come back to the market because they're not fit to work, and that is a testament to the NHS waiting list we're seeing. That is why a lot of people are just unfit for work, and you've seen sickness benefits rising accordingly. That's created skills deficits right across the economy. Brexit compounded that to an extent as well. And as a result, you've got this incredibly tight labour market. You're seeing wage inflation coming in at quite high levels. The latest figure, wage inflation in the private sector was 7.6%. In the most recent month now as well. And accordingly, companies, employers are passing on those price increases where they can. So we're in this sort of situation now where we are in a sort of price-wage spiral. Prices go up, wages go up to follow them up, and then prices go up again. That's the kind of situation that we are in right now in the economy. The Bank of England is trying to throw grit in the wheels of that process by raising interest rates, but it hasn't really had an impact thus far. It's worth noting that Andrew Bailey, the Bank of England governor, pointed out in a speech fairly recently, he felt that only about a third of the impact of the Bank of England's rate rises to date have actually been felt across the economy. And that is why you're not seeing inflation coming down despite this very severe medicine that the Bank of England has been applying. And again, there are a number of factors behind that, one of which is the fact that there are a lot of people now are on fixed rate mortgages. Previously, in previous rate tightening cycles, a lot of people were on variable mortgage rates, and accordingly, when the bank would raise interest rates, well, that would be fed through to customers fairly rapidly, and that is a big issue for the bank, the fact that that is not happening this time. Now, it is actually starting to take place. You're starting to see interest rate rises being passed through by the mortgage lenders. And we only heard this morning, for example, the average two-year fixed rate deal is now 6.19%. We've also seen fewer mortgage products on the market than we did previously. And again, that makes life very, very tough for homeowners when they're trying to roll over their mortgages and come off fixed rate deals. And that is a big factor right now, because if you cast your mind back to the pandemic, the government introduced a stamp duty holiday. A lot of housing transactions were not subject to stamp duty. Interest rates were obviously at the ultra low level of 0.1% at that time. That meant mortgages were incredibly cheap for homeowners, and accordingly people fixed in. Well, a lot of those fixed deals, if you think of someone who fixed 2 to 3 years ago, they're now facing probably increases of around £200 to £300 a month extra in their mortgage payments.
Well, it is 12 o'clock. We are awaiting the interest rate decision from the Bank of England. We will bring it to you as soon as we have it. Ian King, our business presenter, is on the line live from the city. Ian, I suppose that the problem for the bank is if they raise it to 4.75, they may feel it's not far enough. But we are hearing, Ian, that it's gone up to 5%. And I suppose with that result, some may worry, does that show the bank is panicking?
Yeah, that is a very, very significant move indeed. I think the bank's hand, the Monetary Policy Committee's hand, Jane, has obviously been forced by those very disappointing inflation May figures that we got yesterday. I think the bank has decided they had no option, really. If you think about the fact that inflation in May was 8.7%, well, that remains more than 4 times the target rate of 2% that the Monetary Policy Committee is mandated to target. And they feel, obviously, they have had very little choice in the matter. What is really quite interesting there is that there's been a body of the Monetary Policy Committee who were against raising interest rates. I'm looking here, Jane, at the press release that the Bank of England has put out. It was a majority 7-2 vote to raise bank rate by 0.5%. So you don't have to be a genius to know who voted against raising interest rates. That would have been Salvana Tunrano and Swati Dengra, who were the doves on the Monetary Policy Committee. What is really, really interesting is that all the other members of the MPC voted to go by 0.5%. There was a bit of speculation in the market that you might see a 3-way split, that you might see some members voting to go by just 0.25%. So the fact that the vast majority have gone for that half-point rise is very, very interesting. I can read you, Jane, a bit of the commentary that we're getting here from the Bank of England. They are noting here, they say, business surveys continue to suggest underlying quarterly GDP growth of around 0.25%. Household spending has strengthened a little, but it's this question about earnings that I was talking about a moment ago, Jane. That is what's really forced the Bank of England's hand here. The fact I mentioned it just before we got that decision. Average earnings increased by 7.6%. in the 3 months to April. That was above the bank's expectations when it last issued its quarterly inflation report. And the bank goes on to say in this statement here, 3-month growth in this measure of pay has also picked up. Now, the bank's suggesting that earnings growth is going to ease over the course of this year, but it's really the fact that you've got these persistent inflationary pressures. They're talking here in the statement about core inflation. Now, we were talking about this time yesterday. Core inflation is the measure of inflation that strips out volatile elements such as food and drink, alcohol and tobacco, and that actually rose in May from 6.8% to 7.1%, and that was another real indication that inflation is becoming entrenched in the UK economy, and that is addressed squarely here in the Monetary Policy Committee's statement. They're saying that core goods price inflation has been much stronger than projected. It goes on to say here that they expect CPI inflation to fall significantly further during the course of the year. Well, we've heard that from the Bank of England before, and it hasn't really materialised so far to date. The bank reiterating here, CPI inflation is expected to decline later this year. They're talking about food price inflation in particular, which they say they think will fall further in coming months. But here is the key statement, I think, Jane. The MPC's remit is clear that the inflation target applies at all times, reflecting the primacy of price stability in the UK monetary policy framework. The framework recognises that there will be occasions where inflation will depart from the target as a result of shocks and disturbances. Monetary policy will ensure that CPI inflation returns to the 2% target sustainably in the medium term. The MPC recognises, and here's the crucial bit, Jane, that the second round effects in domestic price and wage developments generated by external cost shocks are likely to take longer to unwind than they did to emerge. There has been significant upside news in recent data that indicates more persistence in the inflation process against the background of a tight labour market and continued resilience in demand. And accordingly, the committee voted to raise bank rate by 0.5% to 5%. And the MPC will continue to monitor closely indications of persistent inflationary pressures in the economy as a whole, including the tightness of labour market conditions and the behaviour of wage growth and services price inflation. And I think this is the bit that will alarm a lot of people. If there were to be evidence of more persistent pressures, then further tightening in monetary policy would be required. And that is something that the bank has hinted at. It's certainly what's being priced in by money markets. You recall earlier on this morning, Jane, when we were chatting about this, I mentioned that the market is now pricing in a terminal rate, which in the jargon is the point at which interest rates peak during the current rate tightening cycle. Well, the market is pricing that in now at close to 6%. So even from here, we have quite a long way to go. Big moment this, the 13th consecutive interest rate rise from the Bank of England since it began raising rates back in December 2010.
Ian, thanks very much. Well, let's go live now and talk to Ed Conway, our economics and data editor, who was at the Bank of England, has just been inside and has rushed out to give us his analysis. Ed, what do you think?
Yeah, well, I mean, this is obviously a surprise. It's bigger than expected, 0.5 percentage point rather than the 0.25 percentage point, which was widely anticipated by economists. It takes interest rates up to 5%. What does it do? It underlines just how concerned they are about inflation. It underlines just how worried they are about the fact that it's not just that overall inflation rate of 8.7%. It's the fact that it's the particular things that they're most worried about. Services inflation, that's rising fast. The economy does look like it's slightly hotter than they expected. And as a result of that, they're having to act. They're having to raise interest rates by more than most people in markets and indeed pretty much any of the economists expected, underlining just how concerned they are about it. In terms of the impact it'll have on mortgages, that's a more tricky question. I mean, if you're on a floating rate mortgage, clearly this will be reflected immediately. You'll see immediately that increase of 0.5 percentage point. However, most fixed rate mortgages, so the things that the vast majority of people are on, they are fixed. They're priced off what's going on in money markets. And money markets, they may already have reflected the fact long ago that the Bank of England was likely to raise interest rates faster and higher than expected, certainly higher than expected. Therefore, it may not necessarily have an immediate impact. We'll have to just have a look at what happens in markets. But yeah, this just shows, you know, when other central banks around the world were slowing the rate at which they're raising interest rates, looking as if they were getting closer to their peak, the Bank of England has surprised everyone by raising interest rates more than expected, up by 0.5 percentage point, so up to 5%, up from 4.5% to 5%. That is big news, it's unexpected, and it just underlines how concerned they are about what's happening with inflation.
And Ed, also the warning from the bank that they're going to keep looking at this and you know, should inflation continue, you know, I think we should clearly all have in the back of our minds that this may well not be the 13th and last rise. This could be the 13th in the middle of many more rises.
Yeah, I think that's the question. No one knows at what point the peak is going to be. I mean, when you think back, not long ago, no one thought it was going to get to 5%, where we are now. As of this moment, just after that decision, we are at 5%, a level that a lot of people didn't think we would actually get to. A lot of people thought that it was going to peak at maybe 4.5%, some people even lower. And so we are just in a different world to the one that we thought we were in previously. And people will ask questions about the extent to which that's because of forecasting failures here. The Bank of England was slow to see see that inflation was rising. They were slow to incorporate higher prices into their forecasts. And as a result of that, some people think they were behind the curve. What they are potentially doing today is to underline to people that they want to be ahead of the curve, raising rates far faster than expected. Obviously, though, there is a bearing for the wider economy. Right now, it is essentially flatlining. This will raise questions about whether you may well see a dip. So might this lead to that recession that everyone's been worried about for quite some time? We don't really know. We're going to have to see. But we will hear from the Bank of England governor a little bit later on today. But to get back to your question, yes, it does look likely that interest rates are going to rise even beyond where they are right now. As for how much, we don't really know. We look at what markets are expecting. Markets are pointing towards interest rates getting up to 6%. But we just don't know. And there's this kind of paradox here that maybe by raising rates a little bit higher today, a little bit faster today, the bank might well be able to make sure that that ultimate peak that we get to might be a little less high. But again, that depends on what happens in markets. And most of all, this is the critical thing, it depends what happens to inflation. So we just need to watch what happens to inflation each month, month by month. And so far, it's been higher than expected in the UK. And the final worry, really, is that the UK does look increasingly like it has higher inflation than most other countries in the developed world, higher core inflation. And now you have this central bank, the Bank of England, moving faster than the Federal Reserve, than the European Central Bank. So it does look like the UK is, if not an outlier, it does have a particular curse when it comes to inflation.
OK, Ed, thanks so much. And we've just had a response from the Chancellor in the last few minutes. Jeremy Hunt has said high inflation is a destabilising force, eating into paychecks and slowing growth. Core inflation is higher in 14 EU countries, and interest rates are rising around the world. But the lesson from other countries is if you stick to your guns, you bring inflation down, an echo of a comment he made yesterday. Our resolve is to do this is watertight because it is the only long-term way to relieve pressure on families with mortgages. If we don't act now, it will be worse later. So that there, the response from Jeremy Hunt. Coming up later, we'll have a series of special programmes with our experts who are primed to answer your questions. Scan the QR code now to put forward your concerns to them. They'll be answering questions live in a special show very shortly at 12:30. And then again, also at 4 o'clock, where our colleagues, business presenter Ian King and Ed Conway, who you just heard from, will be joining our presenter then and will be answering your questions. Let's just bring you the latest on what is happening in Newfoundland. Now, you may have spotted that it is 11 minutes past 12. It was estimated that 8 minutes past 12 was the crucial time, that crucial point that oxygen may well have run out in that submarine. We're getting news from the US Coast Guard that the Canadian vessel Horizon Arctic has deployed an ROV, that's an underwater robot, which has reached the seafloor and began searching for the missing sub. And also the French vessel Atlantique is preparing their ROV to also enter the water. So we know that the French and the Canadian rescue vessels that have been motoring towards that spot where the Titanic went down and have been crisscrossing the ocean above have now managed to get a rescue submersible down there, something that could pull a submersible up. But of course, the key thing that they have to do is find it in the first place. Well, our international correspondent John Sparks joins us live now from St John's Harbour in Newfoundland. And John, this point, this time frame that is an estimate, has now passed. What is the feeling where you are about the hopes of bringing these people back alive?
Well, look, it's a good question. And when you ask people about this, they say, look, we're 100% committed to this search and rescue operation. And there is a lot going on here, and I'll just run it through for you very quickly. 5 vessels on the scene, 2 private deep-sea cable-laying ships, 2 Canadian Coast Guard vessels, the Polar Prince, that's the vessel that put the submersible Titan in the water on Sunday morning, and the American coordinators have made that the Joint Command Center for this operation. That's right above the wreck of the Titanic. And then, as you said, we've got 2 more vessels that have arrived this morning. The Horizon Arctic, it's a supply ship. We saw it being loaded up about 36 hours ago with an ROV, that's a robotically operated vehicle supplied by the US Navy, and a specialist deep-sea winch as well that can drag up heavy objects from the ocean floor. That's there now, and we understand that they have put their ROV in the water. The French scientific ship, that's called l'Atalante, it also has a sophisticated ROV, a remotely operated vehicle. We understand that they are about to put that in the water. This could be an important development. It's a very sophisticated piece of kit. It's attached by a cable. The submersible is attached by an 8-kilometer long cable, so theoretically it can go to very deep depths. It also has a robotic arm attached, so it can cut bits of metal, it can manipulate objects, potentially the submersible Titan, in deep depths. So that is about to go in the water as well. All part of this remarkable international coalition. I can tell you that the British are also involved. They've got specialist personnel and commercial mapping equipment, commercial mapping technology. That is on the way today, we understand, as well. As you were saying, I think the thing that is on everybody's mind here is about oxygen, the oxygen levels on the Titan. It's a theoretical thing. Theoretically, as far as we know, their oxygen supply, if that vessel's still intact, that oxygen level would be depleted or very close to being depleted now. But it's theoretical. It depends on how people are breathing, how calm they are, the level of activity inside the craft. But I think there is a very real understanding that if a rescue attempt is a practical possibility, that craft needs to be located, and they need to start with this rescue, which would take hours. It would take a long time. That would need to start very quickly indeed. I think what we're going to see is that the search and rescue team concentrate in the area where they've heard these sounds from the Canadian sonar buoys dropped by a Canadian patrol plane. We're talking about a vast area of ocean. We can't assume that the Titan is simply lying on the bottom of the ocean in a fixed position. It could be floating, it could be moving. And we're talking about a vast expanse of territory here, or of ocean. So they're going to have to focus their search. I would expect they focus on the area where they have heard these sounds, throw their assets, as they call them, their resources, at this particular area, and essentially hope for the best. I think that's what they'll be doing.
OK, John, thanks very much. Let's just bring you a bit more breaking news about the interest rate decision that we got from the Bank of England a short while ago. Just looking at sterling, sterling's down against the dollar at 0.12%. It was last at $1.2752. Let's get reaction from the Shadow Chancellor, Rachel Reeves. She's just been giving her thoughts.
Today is an incredibly worrying time for many families right across the country who are concerned about what happens when they come off fixed-term mortgage deals. Already, people were facing mortgage payments of £3,000 on average more than the rates they were coming off of. This is going to heap even more pain on ordinary working families. It's why today Labour have set out a 5-point plan to help people with their mortgages. If I was Chancellor today, I would be instructing banks to support customers by enabling them, for example, to move on to interest-only products, to extend the term of their mortgage, and to halt repossession proceedings for 6 months. Just some practical things that could be done right now to help people who, through no fault of their own, are facing huge increases in their mortgage costs.
It sounds like you disagree with some other opposition parties who have been calling for direct state support to help people pay their mortgages. Why do you think that would be a bad idea?
First of all, we've got to have a targeted scheme. There are people who are particularly impacted, who are really struggling right now through no fault of their own with those higher mortgage payments. But also, we do have a huge inflation. Lots of untargeted fiscal support from the government is not the right response when we need to tackle inflation. But the targeted approach that I've set out today with our 5-point plan for dealing with the Tory mortgage penalty is about getting practical support right now to those who need it most.
Do you think now a recession is the only way to squeeze inflation out of the system? And would that be a price worth paying?
I don't agree with that, and I know the worries that families and businesses are already facing now with higher energy bills, higher food prices, and now the higher mortgages and rents that are coming our way. The bank need to make the decision that they need to make, but that's what asks to help with the cost of living crisis or the 5-point plan for mortgages that we've set out today, that we do everything in our power, and I would, as Chancellor, do everything within my power to help those who need it most.
I think that's what the bank is trying to do with this quite high rate rise, though, tip the economy into recession to try and get inflation down.
But the bank have got a mandate for inflation, the 2% inflation target. They need to take the decisions that they think are appropriate. And unlike the Conservatives, I'm not going to give a running commentary on the bank's decisions. It is right that they have that operational independence. But the government need to do what only they can do, which is give that instruction to the Financial Conduct Authority to ensure that banks are properly helping customers who at the moment are very, very worried about what these increases in interest rates and mortgage rates mean for them, their families, and keeping a roof over their head.
You used to be an economist at the Bank of England. Do you think Andrew Bailey's doing a good job? Do you think your old colleagues here are doing a good job handling this inflationary period?
Bank of England independence was one of the greatest achievements of the last Labour government. The Conservatives spent a large proportion of last year undermining the independence of the bank, of the Office for Budget Responsibility, and of course sacking the former permanent secretary at the Treasury. I recognise that economic stability, financial and fiscal stability are the rock upon which all other economic policies must rest, and undermining those independent economic institutions will only make the challenges that we face in getting a grip of inflation and growing our economy even harder. So I will not, unlike the Tories, indulge in that sort of politics.
Look forward to serving your first 4 years in government with Andrew Bailey and his last 4 years in term as governor. There'll be no plans to change that at all.
I'm not being complacent at all about what happens at the next election. Labour will be fighting for every vote. But with me as Chancellor, all of our economic policies will be built on that rock of economic, fiscal and financial stability.
Thank you very much.
Thank you.
Well, that there, the Shadow Chancellor, Rachel Reeves. We've already heard from the Chancellor, Jeremy Hunt. We now got a statement from Andrew Bailey, the Governor of the Bank of England. He says, we've raised rates to 5% following recent data which showed that further action was needed to get inflation back down. The economy is doing better than expected, but inflation is still too high and we've got to deal with it. We know this is hard. Many people with mortgages or loans will be understandably worried about what this means for them. But if we don't raise rates now, it could be worse later. We're committed to returning inflation to the 2% target, and we will make the decisions necessary to achieve that. So that their statement from the Governor of the Bank of England. This is Sky News Today. Coming up, one of the key faces of the COVID pandemic says some experts may be reluctant to help in a crisis again because of the abuse they received. We'll bring you more from Sir Chris Whitty at the COVID inquiry. Hello, welcome back. Millions of homeowners are facing increases on their mortgage payments after the Bank of England raised interest rates to 5%, its highest rate in 15 years. Well, the rise is an attempt to combat stubborn inflation, but it means a further squeeze on households which are already going through a cost of living crisis, feeling the effects of rising prices. It's a time of uncertainty and worry for many, so we wanted to ask a selection of specialists to answer any questions viewers may have. Joining me now is Jagjit Chadha, Director of the National Institute for Economic and Social Research, personal finance expert also Gemma Godfrey, and Rachel Neal, who is lead campaigner for the organisation UK Mortgage Prisoners, which campaigns for fairer mortgages. Thank you all so much for giving your time to join us and answer our viewers' questions today. Jagjit, to you first of all, why is inflation so high at the minute? I suppose is a pretty straightforward opening gambit.
I think we understand the forces that have been acting on inflation. The supply side of the economy has been damaged by Brexit, by COVID, and by the increase in energy and food costs. And if you have damage to the supply side of the economy and demand stays where it is, what you get is inflation rising. The more demand than there are our ability to produce goods and services. Inflation has increased to levels that we haven't seen for 40 years. the core level of inflation is something that's very worrisome. So interest rates have risen very, very quickly to levels in order to try and bring down demand back in line with the level of supply that has been damaged by a number of events over the last 7 years. It's a terribly difficult time for many people, particularly after the shocks that you've already talked about. But I'm afraid bringing inflation down is also a precondition for better long-term prospects of the British economy. The bank has done it today by making a large signal of trying to sort it out with a final increase up to 5%. That's it's enough.
Well, you say final increase, but we'll dig a bit more into what Governor Andrew Bailey's words have said as well. Gemma Godfrey, personal finance expert, 5%. We spoke yesterday, and you were talking about inflation and how the impact that was going to have. What impact is this 5% going to have on a lot of people?
I mean, this is a major increase. So what we've seen is it's the 13th increase in interest rates. They're now at a 15-year high. And people were expecting potentially 0.25% increase, and this is 0.5% because the Bank of England want to be perceived as being very, actively trying to fight inflation. But for us, for people at home, this is a big jump. And there are 1.4 million of us homeowners that are going to be coming off of a fixed rate mortgage this year, because obviously people on fixed rate, of course, they're more protected from interest rates. But when that fixed rate ends, then you go onto a variable rate. And so people are going to have a massive jump in the amount of money that goes out every month for mortgages. What this also means is landlords under the equivalent pressure are going to be passing this on to renters. So, I mean, the whole point of raising interest rates is to try and help bring inflation down, because people are spending more money on food, as we know, on energy, transport, and the latest figures show we're now spending more money on restaurants and on services as well. But in the short term, the immediate effect is that it's going to make borrowing a lot more expensive. And this is a very big jump for people to be able to swallow.
Gemma, we've had a question from Hannah who's got in touch with us. She says, how high do you expect interest rates to rise to? Is there a chance of them coming down?
So the long-term prognosis is that interest rates eventually should come down when they've successfully fought inflation. So the reason why interest rates are increased is to make it more expensive to borrow, more expensive, therefore, it means that they're going to rein in spending a little bit more. But the issue about when are they going to peak, markets are pricing in that they could reach 6% by the end of the year. If you listen to the language in today's announcement, the Bank of England have said that if wages, the inflation that we're seeing in wages stay persistently high, that they would take further actions. They are actually saying actively that they would do further interest rate rises to be able to fight inflation. And currently it's so sticky. So, we're talking about when's the end in sight, and people were talking about it ending this year, but unfortunately the forecasts have got a little bit worse.
Let's bring in Rachel Neal, lead campaigner for UK mortgage prisoners. I think, Rachel, first of all, just explain to us, what is your organisation and what is a mortgage prisoner?
So a mortgage prisoner is basically somebody that was sold on by our government to inactive lenders after the financial crash, because we had our mortgages with Northern Rock. Then what has happened is, what is ironic now, is that we've been campaigning and fighting for near on 5 years because our interest rates have been at 5 and 6%, and we've been asking the government to do something about it because they were the people that sold us on in the first place. We weren't bad payers. There's a narrative around that, but there were no bad payers. The bank collapsed and they were bailed out. We're now seeing interest rates of anything between 8, 9, 10%. So we're on the worst scale of this problem. And ironically, it's now, being seen as this huge mortgage bomb that's coming because people are seeing interest rates going to 6%, but we've been stuck on those rates for so long. And we're now seeing people are going to fall off the end of a cliff because they're going to be made homeless because they simply can't keep up with the rates that they're seeing at 8 and 9%.
Let's go back to Jagjit. Jagjit, we've got a question from somebody called Joanna. Now, she says, what does this mean for those on fixed rate mortgages for the next few years? Well, I think it's pretty straightforward, isn't it? If you're on a fixed rate, you're compared to the situation Rachel and her friends are in, you're in a pretty lucky position, aren't you?
Yes, I think, again, I'm not here to give mortgage advice per se, but people can see that interest rates are going up, and therefore whenever they move off their current fixed rate onto something that will be higher, they'll start preparing for that now in terms of increasing their savings. And that's, in some sense, part of the idea of raising interest rates, is to encourage those people who can, and we certainly should talk about those who can't and what ought to be done to help them. But for those people who can, to increase the level of savings that they have in order to provide a cushion, but also to allow more domestic investment in the British economy, which has been short for a very long time. So I would start to think about the fact that at some point, it's very likely that the interest rates you're going to have to pay on a refix will go up, and therefore handle your domestic finances accordingly if you can.
Yeah, so plan ahead. And Jagjit, also to you, a question from Stephen, and you did touch on it earlier. How much do you think Brexit has contributed to inflation?
Well, first, Brexit itself was a decision of the British people at a referendum, and today's the 7th anniversary, I think, of that referendum. And we carried on this process of leaving the strong trading relationship with our major trading partners in Europe in an abrupt manner that has affected our ability to import goods and sell services to those countries in this period. And there are estimates out there from a number of academics, but in general, looking at the literature, it looks like it's added around 2% or so to inflation over this period. So when we see that core inflation, which is what you get when you strip off energy and food prices, is at something like 7%, it could have been up at around 5% or so had we not had a Brexit. And of course, the Brexit as well has limited labour supply at this time. Many people went back to their country of origin during COVID, didn't return afterwards, and they were particularly people working recreation, hospitality and other services. And it's of note that those are the sectors which are showing very high levels of inflation, as costs in those sectors have increased as well. So the Brexit shock is kind of interacting with things that happened later on to amplify the impact on the domestic economy. And that's, I think, one of the reasons that we've seen such an elevation and stickiness, as Gemma said a few minutes ago, in the inflation path.
And Gemma, bringing you back in with, Jagjit, said, for those on a fixed rate mortgage, you're lucky in the sense that you're not going to be impacted immediately, but you have to start thinking and planning for what's going to happen when that comes to an end. Someone has got in touch with us, Atherton has got in touch to say, I have 12 months left on my current fixed rates. What should I do? I mean, I suppose I would say, don't panic, but panic.
Well, actually, it's a little known fact that you can lock in a fixed rate mortgage deal 6 months in advance. So give yourself options. See, obviously, if interest rates continue to rise, you could get a better deal today than you would do after further rate rises. But just I would have a conversation with different mortgage brokers out there and different banks to be able to see what offers you can have on the table. Because look, if there isn't anything that's good enough at the moment, you do have the opportunity to wait. But making sure, I think, so number one, trying to lock in a better deal and give yourself time. Secondly, absolutely, and this was also mentioned as well before, going through your finances and being prepared for the fact that, your mortgage, it has to be affordable now, but what happens if you have a bad month? So while you might be able to fix your rate, your actual family finances might change because obviously we might see job losses, we might see other effects in the economy, and also the just general cost of living is going to get more expensive. So whatever mortgage deal you can afford today, it might get a little bit less affordable, in a few months' time as well. So if you can give yourself a bit of a buffer, ideally, and I know a lot of people are struggling and they won't be able to afford that buffer, but being able to plan ahead will be very important, especially at this time. And I think just putting it in context, we've had 40 years of very low inflation. This is a very different way for people to be managing their money, to get used to the fact that going forward and quite quickly, things are getting more expensive.
And I suppose, Rachel, bringing you back in from UK Mortgage Prisoners, the idea of having a buffer, the idea of having money stashed away that you can call upon for this now rainy day is a nice idea, but a lot of the people that you represent won't be in that position.
No, they don't have any buffers, and they were already in a horrendous situation, paying 5% and 6% when everybody else in the country was seeing rates of 1%. And the government did absolutely nothing to help us. The difficulty is now is that the rates are completely unsustainable. We're not in the general market. We were sold on to companies that are effectively debt collectors, so therefore they don't offer any products. So, and the main difficulty for mortgage prisoners is because when they took out their mortgages pre-crash, affordability rules changed by the FCA. Therefore, they don't pass affordability now, and they haven't done anything wrong. You know, these people have been paying these high rates for nearly 15 years. And not just that, we've got a huge issue with interest-only mortgages, because there's about 1.4 million people in this country with interest-only mortgages that are coming to the end of their term, and they're either going to be made homeless or have to go to their local authorities to find new housing because they simply can't remortgage.
It's a terrifying prospect, isn't it? Jagjit, we asked you to look into your crystal ball for interest rates, but what about mortgage rates? I mean, how high do you think they could potentially go this year? The governor of the Bank of England, we should say, that in the last half hour, he made a statement and he said that, let me just see if I can dig it out here. I mean, he basically gave a warning that, you know, that they are going to continue to look at interest rates. We're committed to returning inflation to the 2% target, make the necessary decisions to achieve that. I mean, there is the possibility that the Bank of England could say, you know, it's going to go to 5.5%, 5.25%, or even more the next month, next quarter.
Well, yes, financial markets over the last week have increasingly priced in a higher peak of interest rates, going up to 6% on some days. And I think that reflects an extent to which the bank hasn't been terribly clear about whether they've done enough on current forecasts and current information that they've got, which I mean, what we've had in the past 3 months are a number of what economists call shocks or surprises to inflation. We expected inflation to come in at a certain level, and when the ONS produced the numbers, it came in consistently higher. So the markets have said to themselves, well, if that's the case, then interest rates might have to go up to something like 6% to bring inflation down. But the key thing for the bank to do, and other commentators, is to take that news and understand, looking at the structure of the economy, the impact on those with debt. We've been hearing some really heartrending stories about the way it's affecting certain households, and try to understand how much that is dampening demand in the economy. Our own view is that over the course of next year, inflation will settle or average over the course of next year at around 4%, and will move towards target by early 2025 at about the current level of interest rates. So you don't need to go up to 6% on the information that we've got. The bank will have the advantage of a full forecast when you do this thing that I've talked about. You look at the whole structure of the economy, you try to understand what the impact is of the interest rate changes that you've had, and then try to project forward where you think inflation will be. So I think that's really critical, that we focus on that view that we develop over the next month or so as to where we think inflation will be. And if we think at around 5%, inflation will come back to something not that far away from the 2% target in a year and a half or so, there should be no need for interest rates to rise, barring any other unforeseen inflationary shocks. So I think that's the way to think about this. The market, I think, in the past few days has got ahead of itself. There is no need at all on current information for interest rates to go up to the levels that they're pricing, it seems to me, looking at the economy. And just one other thing, if I may, we've heard a lot, and you said in your opening remarks that 5% interest rates are the highest they've been since 2008, 15 years. And that itself is a shock and a surprise to many people. It's not anticipated. So what we also know is that when interest rates move in a way that surprises you or shocks you, it's likely to have more of a dampening effect than something you've already anticipated. So it's incredibly important that we try to understand how much the move from 0.1 to 5% in 13 consecutive meetings, how large an effect that has on the British level of demand in our economy for consumption investment. My own view is that change in regime has had a very large effect that we don't fully understand. And so we should move very carefully from here on in.
OK, so it's all about the psychology, isn't it? It's absolutely fascinating. Jagjit Chadha, Rachel Neal and Gemma Godfrey, thank you so much. We're going to come back to you guys. After this short break, we're going to be getting more questions for our panel. Misery for millions of homeowners following this interest rate rise. We'll keep on with your questions. Stay with us. Welcome back. Let's return to our panel who are answering your questions following the Bank of England's, some would say, shocking interest rate rise to 5%. Joining me now, Jagjit Chadha, Director of the National Institute of Economic and Social Research, Gemma Godfrey, personal finance expert, and Rachel Neal, lead campaigner for UK mortgage prisoners. Straight back in with you, Gemma, this half. Pete has got in touch to say, how does the mortgage crisis affect me as a prospective first-time buyer? I think we may have lost.
So it's a very good question.
Sorry, Gemma, give it one more go. How does the mortgage crisis affect me as a first-time buyer?
As a first-time buyer, obviously the criteria for lending is getting. Banks are focused much more on whether somebody can afford the mortgage on an ongoing basis, and also if there are any shocks to their finances as well. It means that obviously immediately the rate that you're going to be offered is going to be more expensive as well. So on average, the 2-year average for a 2-year fix, the average rate was 6%, and it started to creep up as well. So it's going to be more expensive, tighter lending criteria. But, there are things available when you are trying to get onto the property ladder. I'd be very wary of, if you're a first-time buyer, the no deposit mortgages. We spoke about this yesterday. What you're doing there is you're borrowing the entire amount of the property. So it sounds very attractive to not have to put a deposit down at all, but you're borrowing a lot. And again, the rates for those products are very high. And if you have a bad month, you're very, very exposed. So really, it's making sure that the product that you're getting out, that you do make sure that it's affordable, and that you have, reasonable negotiation, and ideally, use a mortgage broker to get the best rate out there. But it is a really, really tricky time, especially to get onto the property ladder. And with property, it's such an emotional purchase as well. This isn't, if you've got something there that you found that you're ready to be able to invest in for the future, hopefully you can get a good deal. But please don't be disheartened, and just try and see best rate possible. Okay,
to Rachel now. Sadie has sent us a question, Rachel. Why hit those with interest-only mortgages hardest when they're likely to be struggling more? I mean, that's a point that you've made, isn't it? It's just incredibly difficult for those whose whole mortgage rate is decided on the actual rate itself rather than repayment.
Yeah, and also, we don't know the circumstances of that question, but I can answer for mortgage prisoners that are interest only, and those not only are struggling with the interest rate rises, so it's hitting them hard, but also majority of them from when they took their mortgage out are seeing their term coming to the end, so they're also in a double difficult situation.
Jagjit, to you, we've had a question from Tony B. He says, as spending reduces, is there a danger of the economy grinding to a halt?
Well, absolutely. If interest rates if bank rate continues to go up, that increases the cost of borrowing. It increases interest rates on unsecured borrowing as well, which is also very large in this country, around £300 billion. I think all of that is the danger the bank's been trying to avoid. One of the reasons that rates were not increased earlier in 2021 is that to the extent to which it looked like the inflation was primarily at that time caused by supply chain issues, the thinking was that that would disappear over 2022 and inflation would start to come down. But exactly as that was happening, the energy and food price shocks caused by the Russian invasion of Ukraine jacked up inflation even further. And the bank then started this process of increasing interest rates.
OK, I'm sorry to cut you off, Jagjit, but we're out of time. We're going to have to take a break. Jagjit Chadha, Rachel Neal and Gemma Godfrey, thank you all so much for answering our viewers' questions. Lots more reaction to this coming after this short break on Sky News at 1.